Hi there, and welcome to today's FatTel Daily podcast. We are really approaching Christmas now. We're coming into the last week. I hope you're gearing up for a nice festive period. Today, to celebrate the end of the week, I'm joined by my good friend and gold analyst, Brian Chu. Brian, welcome, buddy.
Hey, Woody. Guess there's a bit of a swap today. Instead of Nick, it's actually me because he took my Tuesday spot.
Yeah, the bugger. All good though. As long as we get the same analyst insights, that's all good. Doesn't really matter when we get them. But look, today you discussed some fascinating shifts we're seeing in global markets and institutions as we head into the new year. Your FatTel Daily piece touches on everything from central bank policy to market psychology, and importantly, how these changes might create new opportunities for investors. Now, what I found particularly interesting was your analysis of how traditional market dynamics and institutional influences are evolving and what that means for investment strategy going forward. So let's dive in. You've outlined some significant potential shifts in monetary policy and central banking for 2025. How do you see these changes potentially affecting investment markets, particularly in areas like precious metals where you're focused? And I guess cryptocurrencies too, which have traditionally been seen as hedges against monetary uncertainty.
Yeah. So my thesis is that this year we've seen a significant shift, not just in the financial markets, but also in geopolitics and possibly what we call the global world order, like how the US, international organizations and other nations interact with each other, and how that will affect foreign relations, trade, etc. Now, at the head of all this is, of course, the source of money, or fake money in this case, with the Federal Reserve, because they set the rate of interest, which pretty much dictates how we price risk and also how business activity happens. So on Wednesday, US time, the Federal Reserve announced their much expected 25 basis points rate cut, which instead of sending the market soaring as it had typically done, because rate cuts increase the liquidity, this time markets actually pulled back. Now, why did that happen is because the markets focus on the reasoning and the reasoning behind why the Federal Reserve Open Market Committee decided to cut rates, but what they expect to happen going forward. So earlier this year, they talked about how inflation is slowing down, and that's why they can afford to cut rates, especially because business activity may continue to falter as a result. So they wanted to increase liquidity into the markets, encourage people to spend, encourage businesses to borrow. But as inflation started turning around, it started speeding up in the second half of the year. And with the expected Trump administration coming in next year, the Federal Reserve is saying perhaps inflation is going to come back, and therefore we're going to cut rates at a slower pace next year because they don't want to increase so much liquidity in the markets as to push prices higher and therefore reverse the work that they claim they've been doing in the last 111 years of keeping markets stable, when all they've done is the very opposite of it.
Yeah, that's a good point. So when was it? It was 2007, right? Sorry, mate. 1907. Yeah. Sorry, not 2007. 1913
when they set up.
And there's, I would say it's been anything but stable. Actually, one thing has been very stable. The purchasing power of the US dollar has gone down 99%.
It's stably decreasing. Yes, that's right.
Yes, exactly. Yeah. Look, Brian, you touch on how social media has increased transparency.
Hmm.
You touch on how social media and increased transparency are affecting markets and institutions. Could you
Yes.
expand on how you frame it as information democratization, and you claim that it's changing the investment landscape? Can you talk about what you mean by that, and then perhaps extend that to the opportunities or the risks that creates for private investors?
Yeah. So what I mean by so we are living in a period of a global information war. So instead of a war fought with simply troops on the ground, bombs, missiles, tanks, bullets, etc., We've now been living through a period where the weapons are information, our outrage, our compassion, our emotions. And people have been, you could say, manipulated to believe or take a stance because of the sources of information that they follow. Now, with the advent of the internet over the turn of the millennium, information is more than just newspapers, television, but now it's at our fingertips with the smartphone, with accessible internet and social media. We can now also broadcast our own information, which is what we're doing right now in disseminating our videos, our newsletters, our ideas.
Mm-hmm.
So certain people are going to like different sources of information. And in the case of our readers here, they prefer they prefer a particular slant where we have more skepticism of the government and our existing official narratives. We watch the news, but we are more likely to read between the lines rather than take what is there at face value.
Well, you kind of have to nowadays, right?
Well, there's still a lot of people who don't exercise that discernment because they still believe that the authorities and the media outlets are like what they were 30, 40 years ago, that were still acting to some extent the interests of the people. Nowadays, you can see how openly they actually don't do this. So with the purpose, with the purchase of Twitter, which is now called X by Elon Musk, the alternative media, which had once been labeled conspiracy theorists, fringe analysts, and debunked sources of information, they now have a platform to fight back. And not only this, there is a more reliable platform in which they can disseminate whistleblower accounts, exposure of corruption and collusion by our sources that we used to believe in. And as more people use this platform, they now realize how they had been tricked, manipulated, and even exploited to do nefarious things, not directly, but through the support of the authorities that they voted for, trusted, and funded through taxpayer money. And now many people are fighting back. And how does this create an opportunity? Well, viewers of our of Factor Investment Research, we've long lived through its skepticism that whatever they've been telling us from the top and through the media platforms, we always ask, is that really true? And for a long time, we've been said to be, well, you're just thinking too much. You're thinking on the in the wrong direction. But now we've been proven very often to be months or years ahead. And even if we don't get it right on the small details, the general gist of everything, we've been proven right. There is something going on in the governments, in businesses, in all these non-profit organizations and these international overreaching bodies that putting out that are actually trying to push an agenda towards their own benefit at the expense of the vast majority of the world's population. And we've seen how dirty and how sad the outcomes have been in the regions that are affected by war, poverty, famine, and sickness. We live in a very lucky part of the world because we are watching the pain of other people from the relative comforts of our own homes.
Ryan, can we just go back to the market's muted reaction to the Fed's, or how you described it, their hawkish cut? Just tell me what you mean by that phrase, just for viewers that might not understand the jargon. And then what does that tell us about current market psychology, and how might people position themselves for potential policy shifts in 2025?
Okay, so we'll first unpack what a hawkish and dovish position is. A hawkish position is one where you believe the markets are looking stronger. So therefore, whatever actions you like to implement is to actually reduce the enthusiasm or to put a brake on it. A dovish position is one where you believe that the economy is weakening, and therefore whatever intervention you like to make would be to spur activity and boost confidence. So normally, a hawkish view means a hawkish view would result in raising in the interest rate to take excess liquidity out of the market, to reduce lending and business activity, and therefore kind of bring it over what would you believe is an overheated market back to
turning the boiling pan down to simmer.
Yeah, that's right. Turning the temperature down. Whereas a rate cut is almost like injecting additional liquidity, turning the temperature up, and trying to spur economic activity. Now, a hawkish rate cut is almost like putting your right foot on the accelerator and putting on the brakes at the same time. Now, why are they doing that? It sounds schizophrenic. And in some ways, the Federal Reserve is, again, trying to talk from both sides of their mouth. On one hand, they've been saying the economy is growing, there's been job growth, even though we know a lot of the jobs data is openly manipulated. They'll report at the beginning of each month how the previous month's job growth is looking great, but they're quietly revising downwards the months prior to that, how the job numbers were actually not as high. So they create the illusion that the economy is growing. And that's why for a while they've been taking credit in saying that what they've done in hiking rates in 2022 and 2023 was great. And now they're going to spur a bit more business activity in order to keep things going. But with President Trump's victory last month, they have suddenly changed the narrative. Instead of a economic growth which is good, and therefore they could continue doing what they're doing, they're going, no, I think the Trump administration is going to spur inflation, and that's not good for the economy. So in order to prevent that from happening, we can't go and encourage economic activity and boost lending by reducing interest rates at the rate that we had been. We're going to have to slow that down because the Trump administration's economic policies don't look good to us. Mm-hmm. So that's why it's called a hawkish rate cut, because they're continuing with their policy of cutting interest rates as they have started to do so in September, but they're claiming if they do this at the current rate, it's going to overheat the economy, so we're going to do less than that. the markets responded and go, oh wait, that doesn't look good. So that's why there's been a sell-off in the expectation that there's less rate cuts, the markets move ahead of themselves, and therefore they've got to move at the pace of the Federal Reserve once again.
Just final question, Brian. You highlight some structural changes happening in various Western economies. From an investment perspective, how can investors identify and potentially profit from these major institutional and policy transitions while managing the associated risks that may come with that?
Okay, so I believe there would be two approaches that one could take. And if you choose that approach, you have to stick to it. Don't try to switch between the two, because you could end up slipping between the cracks and losing quite a lot of money in the process. So the two approaches I'm talking about is, one, you either follow the market's momentum, so therefore you invest with the market. Whatever is going up, you watch the extent in which the momentum indicators show you that there are that this could continue, and therefore you trade in and out of those positions. That's where my colleagues such as Murray Dawes and Callum Newman, that's where they make a living, and that's where they help their newsletter readers succeed. The other approach is to pick out the themes which you believe would benefit in the long term, and you home in and identify. You learn all about the dynamics in those types of markets. It could be, for example, cryptocurrencies, precious metals. It could be blue chip stocks, mining, or construction, healthcare. But you are focusing on understanding how that industry behaves during these cycles. And you would, rather than buying in and out, you choose the best companies, and you slowly accumulate. When the market is weak, you don't let the short-term price movements shake you out of your position. And when the cycle turns in the favor of your industry, then you take your profits, and you usually make significant gains that would more than cancel out the losses that you could accumulate on paper when the cycle doesn't work in your favor. So you could see those two approaches are very different. You could allocate part of your portfolio on one approach and part of your portfolio allocation on the other. But you should not, and this is not financial advice, but I still would suggest that whatever you choose, you must stick to it. But find a suitable financial advisor or someone to guide you in order to make this journey work. That way, you could maximize your long-term gains and weather the storm of bad economic and monetary policy decisions, which we've seen in spades, and I expect to continue into 2025.
Yeah, I'll wrap it up there. But you do exactly that in the precious metals and gold markets, and you've been through those cycles, and that's where you specialize in. And that's actually what we're going to be. We've got an exciting first week of January coming up for all FatTail Daily readers. It's an 8-day consecutive day interview series with many experts out there in the gold industry. I'm really, really looking forward to kicking off 2025 with that. Your Nick Hubbell's actually conducting interviews. The series is hosted by you, and I think you accumulate with Nick and yourself having a chat about the gold market as well. So yeah, really looking forward to that, Brian. Until then, have a great Christmas and Happy New Year. I'm sure I'll talk to you in the meantime, but we will jump right back into it in January.
Yes, indeed. And to everyone who's watching, we hope that you have a safe and happy period for Christmas and New Year. Good health to all of you, and God bless.
Thanks for tuning in to FatTel Daily. If you're ready to take a new approach to building wealth, avoiding the same old mainstream ideas and investigating new market trends, then make sure to hit the subscribe button and turn on post notifications so you don't miss a single video. Until next time.